Hello, dear students. Welcome to the first episode of Financial Management, Introduction to Financial Management. It includes nature, scope, functions and significance of financial management. Besides this, the discussion will also throw light on the role of financial manager and organization of finance function in a business enterprise. I am Dr. Arshia Hussain, PhD in Human Resource Management and teaching in the Department of Commerce and Business Studies, Jamia Millia Islamia University in New Delhi. I have my students, she is Aditi and she is Uneza. Both of them will actively participate in the discussion. So let's define financial management as the first part of the introduction to financial management. Financial management is one of the most important functional areas of management. It relates to the management of finance. It is concerned with planning, organizing and controlling of financial activities in a business organization. Here are some definitions of financial management given by various scholars. According to Gutman and Dogel, financial management is the activity concerned with planning, raising, controlling and administering of funds used in the business. According to J.F. Brandley, financial management is that area of business management devoted to a judicious use of capital and a careful selection of the source of capital in order to enable a spending unit to move in the direction of reaching the goals. According to Solomon, a very famous financial author, financial management is concerned with the management decisions that result in the acquisition and efficient use of an important economic resource, namely capital fund. Next, we'll throw light on the characteristics of financial management. The first one is financial management is an integral part of overall management. Second one, finance is a continuous function. Finance is continuously needed for planning and controlling the financial activities of the business enterprise. The third one is the central focus of financial management is the valuation of the firm. This means that financial management aims at increasing or maximizing the value of the firm. The fourth one is it involves risk-return trade-off. It means that financial management involves selection of those assets which generate returns. Generally, higher returns are associated with higher risk and vice versa. The manager therefore has to maintain a trade-off between risk and return. The fifth one is management of finance is applicable to all types of business organization, that is, be it corporate or non-corporate manufacturing or service providing firms. The next one is scope of financial management. The scope of financial management can be dealt in two ways. The first one is traditional approach and the second one is modern approach. We'll take a look at the first one, traditional approach. The traditional approach to the scope of financial management defines financial management in a narrow sense. It refers to the procurement of funds by business enterprises to meet their financing needs. The term procurement includes raising funds externally. Under traditional approach, financial management raises funds externally from three interrelated aspects. The first one is the capital market. Second is the financial instrument. And third is the legal and accounting relationship between the firm and its sources of funds. The traditional approach has been discarded due to certain limitations. The first limitation of traditional approach is that it laid emphasis on issues relating to the procurement of funds by corporate enterprises. The second one is it focused only on the financing problems of corporate enterprises and ignored the non-corporate organizations. The second one is the modern approach. The modern approach views the term financial management in a much broader sense. It provides a conceptual and analytic framework for financing decision making. According to modern approach, the finance function covers both acquisition of funds as well as their allocation. It views the financial problem in an analytical way. The main contents of the modern approach are: the first one, what is the total amount of funds an enterprise should acquire? The second one is, what specific assets should an enterprise acquire? The third one is, how should the funds required be financed? Next is functions of financial management. The functions of financial management can be broken down to decision making into three major areas, namely, first one, investment decision. Second one, financing decision. The third one, dividend decision. We'll take a look at one by one. The first one is investment decisions. Investment decision as a function of financial management relates to the selection of assets in which funds will be invested by a firm. The asset which can be acquired can be classified into two broad categories. Number one, long-term assets, and number two is short-term assets. Long-term assets are those assets which give a return over a long period of time in the future. For example, machinery, land and buildings, plant, furniture, fixtures and fittings. On the other hand, short-term assets are those which during a normal course of business operations are convertible into cash during a period of 1 year without a loss in the value. Examples of short-term assets are cash, bank, ready marketable securities, stock, debtors and bills receivable. Short-term assets are also known as current assets. Investments in long-term assets are known as capital budgeting decision, while investments in the short-term assets are known as working capital management or management of working capital. Capital budgeting is a very important decision and should be evaluated in terms of expected return and the risk associated with the return. Working capital management is related with the management of current assets. It is important for the short-term survival of the business. Regarding the working capital management, the firm has to maintain a trade-off between the profitability and the risk. Second function is financing decision. Another important decision of financial management is the financing decision. Financing decision relates to the composition of the assets of the firm, known as the capital structure of the firm. By capital structure, we mean the total capital funds raised by a company. It involves two types of decisions. The first one, the type of securities to be issued, and second one, the relative proportion of each type of security. A capital structure with a reasonable proportion of debt and equity capital is known as the optimum capital structure. A proper balance has to be maintained between the risk and the return to the shareholders. The third function of financial management is dividend decisions. Dividend decision involves the proportion of profits to be distributed as dividend to the shareholders. Dividend decision is a very significant decision in the financial management. Dividend is that part of the net profits which is distributed to the shareholders. The finance manager has to decide whether the company should distribute its profit in the form of dividend or should retain them or distribute a portion and retain the balance. The company should adopt that dividend policy which maximizes the market value per share. Next, we will take a look at the objectives.
Excuse me.
Yeah.
Ma'am, I have a question.
Yes.
Ma'am, what is the optimum capital structure regarding the dividend decision?
See, optimum capital structure regarding the dividend decision or the financing decision is when you employ the maximum profitable source of finance. There is, as such, there is no optimum capital structure. For one particular business organization, optimum capital structure could be 1. For the other business organization, the optimum capital structure could be different. So, for any particular business organization, the concept of optimum capital structure is different because they are giving different returns to different organizations in different ways. One can employ more of debt and less of equity. The other organization can employ or can take up in their portfolio more of equity capital and less of debt. So, optimum, the concept of optimum capital structure means which gives maximum return to any particular organization. Is this clear?
Yes, ma'am. Thank you.
So, now we will start with the objectives of financial management. There are two objectives of financial management. First one is maximization of profits and second one is maximization of wealth. First, maximization of profits. The first basic objective of financial management is profit maximization. The term profit maximization means maximizing the rupee income of a firm. Profit maximization as an objective of financial management has the following advantages. Number 1, the concept of profit maximization is simple and straightforward. Second, it's a yardstick by which economic efficiency of a firm can be measured. Third one, profit maximization as an objective of financial management promotes economic and social welfare. Number 4, the concept of profit maximization leads to efficient allocation of resources. But despite of the advantages of profit maximization as a goal of financial management, it has also been criticized on the following grounds. The first one is the word profit is vague and ambiguous. The word profit has no precise meaning of its own. It is subject to different interpretations, such as which profits are to be measured, short run or long run, profit before tax or profit after tax, gross profit or net profit, and so on. Second one, the concept of profit maximization ignores the time value of money. That is, it does not take into account the timing of benefits expected from investments. In other words, it ignores an important fact that money received today is more valuable than received later. The third one is profit maximization as an objective of financial management ignores quality of benefits associated with an investment proposal. Quality of benefits means the consistency of returns associated with a financial course of action. It gives no weight to the degree of uncertainty of future benefits. Now, due to these limitations, profit maximization is considered as unsuitable operational criterion for financial management. Maximization of wealth is the second objective. Wealth maximization is also known as net present worth maximization. It is considered as an appropriate operational criterion for financial management decisions. Wealth maximization objective takes into consideration all those factors which were ignored by profit maximization objective. That is, it considers exactness, quality of benefits and the time value of money. The relationship of financial management and other areas of management. Finance is the blood of business. Without finance, the heart and brain of business cannot function. There are various functional areas of management such as production, marketing management and human resource management. All these functional areas are interrelated. Finance is needed to perform every function of business enterprise. Finance facilitates the performance of all the functions efficiently and effectively. We will see how finance is required to perform various functions. Financial management and production management is the first one that we will see. Finance manager has a very significant role in the production management. The production department is concerned with the decisions relating to plant layout, selection of a new technology, productions or operations, regular and continuous flow of materials and so on. All these decisions cannot be formulated and implemented unless sufficient funds are available. For instance, many textile firms in India became sick because they did not provide finance for modernization of plant and machinery. The next is Finance and Human Resource Department. The Human Resource Department of an organization is concerned with the responsibility of recruitment, training and placement of the employees. The Department of Human Resource also critically analyzes the requirement of manpower in an enterprise. And in case of excess manpower, the department is required to suggest ways to reduce them. Welfare of the employees is also the responsibility of HR department. Therefore, HR department is required to take different decisions from time to time. Finance plays a crucial role in HR department because all the decisions are evaluated in the light of sufficient funds. Different schemes of training programs, employees' welfare, economy in manpower, computerization, incentives schemes, revision of pay scales and so on can be evaluated and framed when sufficient funds are available. Finance and marketing are interrelated. The marketing function of a firm is concerned with the ultimate activity of the firm, that is, selling of goods and services to the customers. This requires framing, marketing, selling, advertisement and other related policies to achieve the sales target. Availability of finance helps a marketing manager in framing and executing these policies efficiently.
Ma'am, I have a question.
Yes.
Ma'am, are the functions of financial management interrelated?
Yes, they are interrelated.
How?
There are three functions of financial management. The first is investment function, second is finance function and the third one is dividend function. Investment is done when you'll do the financing part. Okay. For buying, investment decision relates to buying of both long-term assets and current assets, that is your short-term assets. For this, we need funds. Funds will be acquired by way of financing function, which is your second function, either by way of equity or by way of debt. So, funds generated by way of equity and debt can be used to allocate or to acquire long-term assets or the short-term assets. With the help of these allocation and acquisition, the firm will earn profit and this profit will be distributed in the form of the dividends. A part will be distributed in the form of the dividends and the rest will be retained by the organization for further reallocation or for further reinvestment. Is this clear?
Yes.
So that's how financial functions, all the financial functions are interrelated. Now, next we will start with the organization of finance function. Finance is a major functional area of any business enterprise. The responsibility for carrying out the functions of financial management is entrusted with the top management. The top management consists of board of directors or managing director or chief executive or the committee of the board. However, the exact nature of the organization of the financial management function varies from firm to firm depending upon various factors such as size of the firm, nature of its business, type of financing operations, ability of finance managers, and so on. Generally, in a large business organization, the function of finance is managed and organized by the Chief Financial Executive, known as CFO. The CFO is associated with the formulation of policies as well as decision making. Under him are the controllers and the treasurers, although they may be known by different designations in different firms. The functions of treasurer and controller are: number 1, the treasurer performs the following functions. Number 1, acquisition of finance. Second one, banking relationship. Third one, investor relationship. Fourth one, short-term financing. Fifth one, management of cash. Then credit administration. Then investments and insurance is the last one.
Ma'am, I have a question. What is the significance of financial management in any organization?
See, I have explained this, that significance of financial management in any organization. Finance is the blood of any organization. Without finance, nothing is possible. For buying raw materials, for purchase of machinery, for purchase of plant, for setting up of the entire enterprise, we need to have finance. So, finance is considered to be the most important function because it is highly significant in every kind of function. For example, your for purchasing department, for production department, for HR department, for recruitment, for selection, for every other function, finance is needed. So, finance is highly significant. It is considered to be the most important function because unless and until you have funds with you, you have finance available with you, you cannot actually start anything. This is how finance is such a significant function of, and it is considered to be now these days, it is a separate discipline and it is so focused because without finance nothing is possible. Is this clear? Now, we will take a look at the functions of the controller. The controller performs the following functions. First one, financial accounting. Second one, internal audit. Third one, taxation. Fourth one, management accounting and control. The fifth one is budgeting, planning and control. The sixth one is economic appraisal. Now, let's take a quick look at what we have discussed in this episode of Introduction to Financial Management. We have discussed the definition, characteristics and scope of financial management. Financial management is concerned with planning, organizing, directing and controlling the financial activities of the enterprise. We have also discussed the objectives of financial management. There are two objectives of financial management. The first basic objective of financial management is profit maximization. But profit maximization as an objective of financial management is characterized with certain problems. such as the word profit is vague and ambiguous and is subject to different interpretations. It ignores the time value of money, that is, it does not take into account the timing of benefits expected from investments. Profit maximization as an objective of financial management ignores quality of benefits associated with an investment proposal. Now, due to these limitations, profit maximization is considered as an unsuitable operational criterion for financial management. The other objective is maximization of wealth. Wealth maximization is also known as net present worth maximization. It is considered as an appropriate operational criterion for financial management decisions. Wealth maximization objective takes into consideration all those factors which were ignored by profit maximization objective. That is, it considers exactness, quality of benefits and the time value of money. The functions of financial management can be classified into three major areas, namely investment decisions, financing decisions and dividend decision. Thus, finance is the blood of every business. It is required to perform every function of business enterprise, that is production, marketing management and human resource management. All these functional areas are interrelated. These functions can be performed efficiently and effectively only with the help of finance. I hope you have understood the concept of finance, its characteristics, its scope. Now we'll discuss the second topic in the next episode. Till then, goodbye. Have a nice day.